Let's do it, folks. Good morning. It's already quite the morning, let me assure you. You will find out why shortly. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Thursday, the 27th of October, National American Beer Day. Happy American Beer Day to those of you who celebrate. I'm your host this morning, JD Durkin. Opening bell rung just moments ago here on the floor of the NYSE by Easterly Government Properties, Inc. With the Dow here, now, like I told you, there's no shortage of things to talk about today. And even as we were preparing for the show here in the final minutes, more breaking news crossing the wire. Martin and I will break that down in just a moment. With the Dow Jones eyeing its fourth positive week in a row, let's turn our attention to what is on tap for this morning's show, which again, we were working on up until just moments before we came on air. We'll break down the latest tech earnings that have disappointed, to say the least, and discuss what could be in store for names like Amazon and Apple as those huge companies get ready to report after the bell today. Plus, new GDP numbers came out about an hour ago or so. They show growth has finally turned positive, but will it last, or is this just a bump before a slump? For more on those stories and so much more, let's now bring in our senior editor and markets correspondent, Mr. Martin Baccardax. Yeah, truly, this is going to be a day where we really get through a lot of topics in a short time. Obviously, we just had a bit of breaking news with Elon Musk we'll talk about in just a moment, but I do kind of want to get a little bit of Fed questions here and some of the more macro environment stuff we'd like to hit on. We follow the Fed's raising of rates closely here at home, but we're also waking up, Martin, if I'm not mistaken, to another 75 basis point hike from the Bank of England. And I'm wondering if you're willing to start the conversation overseas and give us a sense about what officials there are saying, since you cover this in the very wee early morning hours when the rest of us are still sleeping.
Indeed. European Central Bank, actually, JD, rather than the Bank of England. But nonetheless, you're absolutely right. It was a 75 basis point rate hike. It takes their key refinancing rate to 2%. It's interesting because the expectation of that hike was fully baked into the marketplace. But of late, we have been assuming that ECB officials and central bankers around the world are going to now just maybe moderate their language with respect to future rate hikes. So we are hearing some of that from Christine Lagarde, the ECB president, in her conference right now. She's speaking to reporters in Frankfurt. And the suggestion is that they are going to be more mindful of interest rate impacts on the broader economy than maybe they had first expected or sort of communicated. That follows on from what we saw yesterday in Canada, JD, with a Bank of Canada rate hike that was actually smaller than expected at 50 basis points. And again, the articulation that officials there are going to look at the rate impact more broadly and not just with respect to the prism of their inflation fight. Now, both of these dynamics have filtered through into the Fed rate hike bet game. And now what we're seeing is a fading of bets on a big 75 basis point move in December. It's down into the low 40%. We're still locked in for 75 in November, but it does appear, at least at the margins, that central bankers around the world are going to start to moderate that language. And that is one of the reasons that we're seeing a decent boost for stocks today and throughout most of the week.
Yeah, so I wonder how much of welcome news was it to see the Bank of Canada go in a bit of a different direction. Like you just said, they're only 50 basis points as opposed to what we've seen here at home or overseas in England. And I wonder how investors here what they may look into for that decision. I think you were just kind of alluding it to. I mean, that's got to be welcome news for investors here stateside to look to our friends up north and say, oh, okay, only 50 basis points. Hey, that's kind of the direction we want to move in, right?
No, I think you're absolutely right. There are two mechanics in the Canadian economy that need to be sort of understood when comparing it to the U.S. The first is that it's incredibly reliant on resource growth, particularly petrochemicals. I'd hate to say that the Canadian dollar is a petrodollar, but to some degree it actually is. There's also a housing market bubble in Canada that is incredibly worrying, not only to Bank of Canada officials, but to government officials as well. And the Bank of Canada doesn't want to be seen raising rates too quickly into that dynamic in order to ensure that housing bubble, particularly in major cities like Toronto and Vancouver, doesn't pop in a damaging way. Again, different mechanics to what we're seeing in the US, but the overall messaging is certainly something that I think is welcome, particularly, JD, when you look at today's GDP numbers. Again, these are backward looking, but I still feel that they're important with respect to us understanding where we're headed in the coming months. Annualized GDP was up 2.6%, better than expected. But underneath that, the prices component fell significantly from the prior reading. And actually, the Fed's preferred measure of inflation, which we'll get tomorrow for the month of September, was actually fairly muted for the 3 months ending in September. So that does suggest that, at least at the earliest stages, and obviously interest rate hikes don't filter through into the economy that quickly, but the reading that we get does seem to indicate that there's a way that the Fed can manage its inflation fight without doing too much damage to the job market and still getting the sort of declines that it needs on price pressures and maintaining growth. That might be a difficult task to hold into the final months of this year, and indeed into 2023. But what it might do, JD, is suggest that if we do tip into inflation, it will be short and shallow rather than one of great depth, and that would absolutely be welcome news to markets.
Absolutely. So let's talk a little bit more about those GDP figures that we got. We did get the third quarter numbers, 2.6 reported versus some estimates of 2.3 or 2.4. Still better than expected here. Growth finally turning positive, but I do want to present to you one sort of counter idea out there that I've heard. This comes from David Kelly, an analyst at JP Morgan, who says that growth could very well turn negative in Q4 and will likely still be very weak, in his words, over the course of the next year. Is there a sense here that as welcome as these numbers may be, and I'm sure the White House is going to look to message on this, right? To come out and say, hey, for all you haters, I'm sure they're not going to use that word. That's my word. Although if the press secretary came out and said all you haters, I'd be really surprised. But it's come out and say, hey, for all you haters out there who wanted to say we were changing the definition of a recession, 2 consecutive quarters, aha, look at the numbers now. But there is some concern here that this might just kind of be a little bit of a mirage given the challenges for Q4 into next year, right?
Yeah, it's a clumsy way to look at economic growth anyway, JD, because it doesn't really account for a lot of the changes in value generation in a particular economy over a given time. But nonetheless, it's the benchmark that we all use. I wouldn't doubt for a moment that we're going to slow significantly or perhaps even dip into recession. I think the mechanics are pointing in that direction for sure. And the signals that we are getting from the bond market, where 2-year yields are sharply higher than those for 10-year notes, which portends a recession on virtually every occasion, does suggest that that's where we're going. But nonetheless, I do think that if in the early stages of the Fed's tightening cycle, it can point to data that shows moderating price pressures, solid overall economic growth, and a steady labor market, they can find confidence in that. And if they were to somehow pause or even reflect on their rate hikes going forward, that could engender even further confidence that we might be able to avoid recession into 2023. A lot is going to, of course, rely on what sort of deceleration we see in headline inflation over the coming months. Arithmetically, we're going to see big changes as a result of the oil price component and the food price component. But the concern, of course, is how embedded those pressures are in wages and other components of the economy. So a heck of a lot of moving parts, but I think you're correct on one point, JD, and that is certainly from a political perspective, the numbers will be welcome. And I actually think, even though they are backward looking, they do reflect on some optimism that the Fed might be able to thread this needle into a Goldilocks sort of scenario where they raise rates and tame inflation, but not so much that they choke off growth.
Martin, is there anything else that's top of mind for you on the macro side of things before we start digging into the woefully disappointing numbers that we've got out of Meta and some other tech companies?
I mean, just apropos to that, JD, one of the interesting things, and maybe it sort of dovetails to what we're talking about with respect to the broader economy, is the comeback that we're seeing for industrial companies. The Honeywell, the Caterpillar, old-fashioned, grinded-out sort of firms are posting better than expected earnings, and they're boosting forward forecasts. Merck as well, McDonald's, some really old-school names, all of them Dow components, really shined over the 3 months ending in September. And that does suggest that if we had been over-reliant on tech stocks to drive markets forward, there is some support coming up underneath from some of these old-school names. That probably, well, it may suggest that economic strength is a little bit more robust than anticipated. Time will tell, but if you're asking for something alongside the GDP numbers, that's what I would point to.
All right, let's move on and talk Meta. Folks, I hope you're caffeinated for this part of the conversation, Martin, because my goodness, is this going to require every bit you have. By the way, I just got a note that said Meta has lost $85 billion in value since the close of yesterday. That's more than the market cap of GM as well as Ford. The stock falling more than 20% at some point here in extended hours. That story has continued now that the bell is open. Meta citing huge operating losses, specifically for its Reality Labs division, which is kind of like the big bet that Mark Zuckerberg is making, specifically on rebranding the company, calling it a whole new thing, refocusing its priorities. The company also saying those losses are expected to grow significantly, in their words, over the next year. Martin, correct me if I'm wrong, it does not seem, at least as of right now, investors are particularly sold on this pivot to the metaverse. Am I seeing this incorrectly?
No, I don't think you are at all. I mean, if we go back to New Year's Eve, this company was valued at about $930 billion. Now we're looking at something in the 280 billion range. So that's incinerating about 700 billion worth of market value in around 9 months. That's an extraordinary change for one of the biggest companies in the United States and indeed the world, and one that was at one point at the forefront of everything social media. The brand disintegration alone has been arresting, but now what we are seeing is simply a doubling down on an investment and capital investment strategy that investors to this point simply do not believe in, and that of course is the expansion of the metaverse. Reality Labs is the division within Meta that organizes and sort of corrals, marshals the effort to build out its metaverse ambitions. It's lost more than 22 billion over the past 24 months. They're talking about it losing even more money going forward, but they're not slowing down on capital expenses as a result, JD. They're going to spend somewhere in the region of $34 billion next year, and they're not going to increase headcount. So that money, for the most part, is going into that Reality Labs bet, because CEO Mark Zuckerberg, who, let's face it, had a vision that none of us had for Facebook back in 2008, has a vision for the metaverse that no one shares at the moment. He was proven right back then. Remains to be seen whether he will be proven correct again. He is asking for patience, but investors are in short supply of that right now, and that's why you're seeing this incredible decline of the stock at the start of trading.
I mean, it's as if you're trying to generationally capture lightning in a bottle not once but twice. No one would doubt Zuckerberg's incredible achievement and foresight into essentially building the modern version of social media. This pivot does seem like it's a tough pill for a lot of investors to swallow. I do want to pull up a quote here from Zuckerberg on the call here, and of course he's defensive, right? And rightfully so. This is his company, and he went a fundamentally different direction. Here's what he said on the call. He said, look, I get that a lot of people might disagree with this investment, meaning the pivot here towards the Meta and AR and so on and so forth. But from what I can tell, he said, I think this is going to be a very important thing, and I think it would be a mistake for us to not focus on any of these areas, which I think are going to be fundamentally important to the future. Why is it, you think, Martin, that the vision seems clear to him, but doesn't really seem very clear yet to many other people? Is this just kind of a still early days fundamental misunderstanding of what the metaverse is, or at least could be?
Well, I go back to the movie The Social Network, which I actually think is one of the best films of the 21st century, I beg your pardon. I think it's just an
Martin, hold on. Oh, hold on 1 second, Martin. We just lost your audio for a sec. I just want to make sure that I got you so we could start the answer over. Martin, you got me now?
I do hear you. Are you able to hear me?
We lost you for a second, though. We lost you shortly after you were about to talk about The Social Network. I was hooked. Would you mind restarting from there?
Yeah, absolutely. The Social Network really sort of expresses an interesting tension in the early days of Facebook, where the co-founders, one of them wanted to monetize quickly, and the other was simply Mark Zuckerberg, focused on its zeitgeist, on whether it was cool and whether it was going to expand simply as a result of people wanting to discover it rather than what it could do in terms of finances. We seem to be in the same situation right now, where Zuckerberg is simply focused on a metaverse that he thinks, he's a little bit older now, of course, is cool. It's going to be something that we're all going to participate in our functional lives. No one believes that at this point, and therefore his constant the echoing of that message on a constant basis and the amount of money that he is putting towards it is simply not being met with any kind of confidence right now, simply because people don't understand it in the way that they probably didn't understand social media when it began to take over in the early part of this century. So again, capturing lightning, as you say, twice is incredibly difficult. But I think Zuckerberg is holding on to that vision because it proves successful for him the first time. He sees something that others don't, and he's not worrying about monetizing it just yet. However, he's doing it with the money from investors who need evidence of monetization, and quickly, because the mechanics of the broader company are, of course, materially different now. Advertising sales are slowing. Engagement time, whilst holding, is certainly not growing to any great degree. And the competition from TikTok and others is a lot more fierce than it was in 2008.
But he did make a TikTok comment, though, on this call, didn't he? If I'm not mistaken, he did indicate, he said, well, at least we feel confident that we're increasing our own market share. And then he specifically said the word TikTok. I mean, he called TikTok out by name, not to like accuse them of anything, but I'm saying he did say, he did address the elephant in the room. I'm not mistaken.
Yes, he absolutely has to. He's done that on a couple of occasions. He had been reluctant to mention them by name in the past, but he did so today, last night, with respect to the competition that he's seeing from social media platforms around the world. And he can't ignore it simply because the money that they are investing in Reels, which is the short form video that you'll find on Instagram, hasn't really triggered the kind of market share gain for that platform compared to TikTok, which has about a little bit more than a billion daily viewers around the planet, an extraordinary number that they have been able to capitalize on incredibly well. Facebook is chasing that at the moment, and they have sort of indicated that they're happy with increased engagement times and ad impressions and things like that. But again, it has to be set against the fact that advertising spending is undoubtedly slowing down. We've heard it from Google, we've heard it from Snap, we've heard it from virtually everyone else. So the kind of money that they will generate from the traditional business is not going to be there to fund this new business. And that will probably have to come from borrowing or from new investors, neither of which are stock supportive at the moment.
Yeah, absolutely. Okay, let's talk about Microsoft and Alphabet here. I mean, we could do an entire hour-long show just on Meta. I'm sure we absolutely could.
Absolutely.
But we do want to talk about a few of these other disappointing earnings so far this week from Alphabet and Microsoft, and that was all before shares of Meta cratered, of course. Yet it does seem as if, at least in pre-market today, and we got to look right now, I mean, right now, at least the Dow is up in the green. I mean, are investors kind of largely shrugging off what happened from some of these tech earnings between those three names alone the last 3 days, Martin? Microsoft, Alphabet, and Meta?
Well, I think that what we are seeing, at least from the tech space, is the support from the lower Treasury bond yields, which tend to have a tidal effect that lifts all tech boats as a result. Certainly, those gains would be more significant. I haven't seen the NASDAQ open, but it looked like it was going to be just a little bit into the red. But the tech declines would be more significant, but for that support that they're getting from lower bond yields as a result of what we saw from Microsoft and from from Alphabet as well. But absolutely, at this point, JD, the market is keying on what we're going to hear from Apple and Amazon after the bell. That's going to be incredibly important, particularly Apple, and particularly what it has to say about consumer demand heading into the holiday quarter.
Yeah, the S&P currently trading down about 1/10 or so. It did start just moments after the open in positive territory before eking into the red. And you're right, of course, the tech-heavy NASDAQ, where a lot of these companies trade, is down 7/10. We knew that'd be the case, but the Dow is up almost 1% right now. So we don't frequently see that that mixture of mixed territory, but we do today,
Dow's
given the unique numbers we got.
Yeah, Honeywell, Caterpillar, and McDonald's, all Dow components and all driving higher. So I'm sure that's what's adding the upward dimension to the Dow. And of course, with S&P, it's a little bit more of a neutral index with a higher tech component than the Dow. So it's going to be down heading into the Apple numbers. And NASDAQ, of course, is just getting flattened as a result of that big decline for Meta.
Yeah, now down about 0.8 or so. I appreciate that context. Now, digital ad slowdown, Martin, that continues to be the big story of the week here. Really going back to last week from our Snap conversation, what other companies out there, I wonder, are now seeing these numbers and are starting to get themselves a little bit more nervous about the overall state of ad revenue?
It's going to be a part of Amazon's numbers for sure. I mean, it's one of the big developments that we've seen with that company is its drive to keep users on the platform for a longer period of time, not just shopping, but doing other things, watching videos, watching sports, and ultimately hitting on ad impressions at the same time. So we'll see what Amazon has to say about that, what they have to say about consumer strength and all the rest of it, and whether or not the web services division can stand up too. But absolutely, I think that decline in advertising spending is incredibly important because it does suggest what companies are seeing in the windscreen. And as we've said on many occasions in the past, when companies begin to cut costs, they look at jobs first and marketing spend second. And certainly there has been some news on the job front, although not as significant as you might expect, but a lot more with respect to advertising budgets being trimmed going into 2023. And I really feel that the advertising spending, whilst it may not implicate companies directly, it's a much better indicator of broader corporate confidence heading into the final months of the year, and it does not look great at this point.
Yeah, great note there about Amazon. I'm definitely looking forward to hearing what they have to say. To this other point here about, oh no, actually we already did, Mari. There's another Mark Zuckerberg question there. I asked you that. Okay, so here's what I want to tie in. I want to kind of slightly go back to the macro conversation in light of tech earnings here, and I wonder how closely you think the Fed is following the trend lines of tech earnings specifically. Obviously, these are outsized companies. They tend to move the indexes. How likely is it that tech alone might help shape Fed actions at the upcoming two meetings, or do you think it's maybe just one thing they're looking at and it might not ultimately hold a whole lot of sway for November, but especially for December?
I would imagine, JD, it'll be a very small component to the mosaic that the Fed officials are looking through as they try to sort of grapple with the broader economic direction and how quickly and to what degree they should raise interest rates. I think ultimately, obviously, tech companies are more sensitive to interest rate increases than their sort of more traditional counterparts. There are a whole bunch of mathematical reasons for that, not worth getting into just at the moment. But what we certainly know is that the four companies, Alphabet, Amazon, Apple, and Microsoft, have an outsized influence on all of the benchmarks, the S&P 500, the NASDAQ, and others. So therefore, the fact that they have outperformed and become incredibly expensive only allows us to understand why they withdraw so quickly when they post disappointing earnings. In other words, what I'm trying to say is that these companies are not reflective as such of the broader economy. Because they are so expensive, they retreat quickly, and the Fed will understand that and not necessarily be swayed in their interest rate path as a result of it. What they are certainly going to be more mindful of is what we see in labor markets, what companies say about hiring, what companies say about wages, and ultimately what we're seeing in terms of headline and core inflation figures going forward. That, I think, will be a far more indicative indicator for Fed decisions than what we see with the big tech stocks.
I do want to get your perspective here. If we could pivot to Apple here, those numbers will be out after the bell. We've been hinting at them here throughout the show, of course, ahead of the key holiday season. What stands out to me for a company like Apple with so much money that's stored overseas, it goes back to the conversation you and I had a few days ago about the strength of the US dollar and what it meant for Microsoft. And I wonder what that impact might look like given the greenback strength relative to information we may hear from Apple.
Yeah, it's certainly going to be a headwind to overall revenues, JD, but those numbers are going to rise pretty robustly, it has to be said. I think we're looking for somewhere in the region of an 11% increase in iPhone sales with similar percentage gains for services. There's going to be some mixed numbers at the personal computing end, but nonetheless, we're looking at an overall revenue total of about $88.9 billion for Apple over the 3 months ending in September. That's just an extraordinary achievement for a company that, as Warren Buffett famously said, all of its products can sit on his kitchen table. It really is an extraordinary thing to consider that you can actually look at the suite of Apple products and still see them generating revenues in the region of $90 billion on a quarter-by-quarter basis. But again, we are looking at what Apple has to say about the holiday quarter because that tends to be its biggest by a wide margin. If we get 88.9 for the September quarter, JD, the anticipation is we'll get somewhere in the region of 129 for the holiday quarter. So that tells you how important Apple's direction is in terms of consumer demand. and what they are seeing in terms of overall demand for the new suite of iPhone 14s, which you'll remember they have not increased prices for. So they're truly hoping that they can weather this inflation dynamic simply by consumer demand alone. It's an interesting bet, and it'll be very entertaining to see whether it comes good.
And it's one of those kind of gambits, right? It's a little bit of a bet because you have to bet that enough of your consumers are right now sort of at the time point by which they say, I've had my device, I've had my piece or pieces of hardware for X number of months or years. Now is the time to get back in and to get the new iPhone. It's very tough, I think, to sort of time. I guess obviously they're Apple, they know what they're doing here. But it's a fascinating part of the conversation. I do wonder from your perspective how geopolitics surrounding China specifically and China backlash might impact Apple. And I wonder, given maybe listening in or reading previous earnings calls, how big a part of Apple's earnings report is China?
China's an enormously important revenue driver for Apple. I think it's somewhere in the region of 20% of overall sales. So clearly what happens in that economy is of great importance for Apple and indeed for anybody who invests in the company. Clearly, the economy there hasn't been at its full strength as a result of Beijing's zero COVID policies. There's actually been an uptick in unemployment as a result. So it'll be interesting to see how those numbers hold up. But from the political perspective that you're alluding to, JD, Tim Cook has been incredibly successful in somehow managing to find a balance between keeping officials in China happy whilst not being seen as kowtowing to them by those here in the United States. It's an incredibly difficult balance to strike, but he seems to be doing it rather well. We have seen in the past, JD, when companies sort of make overtly political statements with respect to China, that they are punished by consumers. Nike being one of the great examples, where it sort of made some very sensible comments about the mistreatment of ethnic Muslims in the northern provinces. Chinese customers began to boycott their products as a result, and Nike took a hit on its revenues. We haven't seen that bubble up just yet for Apple. Now, whether or not Apple could be sort of the poster child of a backlash that's linked to the U.S. Tariffs on China-made goods or the restriction on tech exports into China remains to be seen, but it hasn't materialized just yet. At the moment, Apple's ability to generate revenues there is more about economics than politics, and that's exactly how Tim Cook would like it to remain.
Yeah, this kind of reminds me of part of the Adidas conversation that we've been having throughout the last week, right? What is your hit on expected revenue? If you do the right thing, you make the difficult decision that maybe your investors financially may not want you to make, but when you are in that place to say, at some point, whether it's an issues of human rights abuses or it's objectively cutting ties with someone who has used hate rhetoric and discriminatory language, there is a hit. And Adidas was very clear on that with regards to Q4, almost $250 million. That last comment there reminded me of that other big story we've been covering this week. With an eye here towards the end of the trade session on this Thursday, I do want to get your perspective on Intel. If we can move there real quick in the conversation, the stock is down roughly 45%, Martin, this year alone. I'm wondering what analysts are expecting here from the chip maker. What an important time for a company like this.
No question about it. I think they're going to have a difficult task articulating their stance at the moment, again, with a lot of moving parts. The expectation is their chip inventory buildup will probably mean a bit of a write-down because we're seeing declining prices as a result of waning demand. And of course, that just expresses what we're seeing in the broader economy writ large. But Intel, of course, was one of the most active proponents of the U.S. government's CHIPS Act, a $52 billion project that looks to entice the development and the manufacturing of semiconductors here in the United States in order to become less reliant on supply chains, particularly in Southeast Asia. It's obviously a very sensible policy, but it does strike some people as being maybe irresponsible in the amount of money it directs to a certain segment of the economy and to many, of course, public companies at the same time. Should the government, writ large, be paying companies like Intel, which has enough investors and enough access to capital markets on its own, to do what it would ordinarily do? That's a great philosophical question. But what it does for Intel is it makes it difficult for them to express cost-cutting measures, such as jobs, whilst they're taking government money at the same time. They may find that to be a little bit more challenging than they first expected. So I'll be interested to see what the company has to say about its growth prospects into 2023, what it's going to say about headcount, and how it's going to balance those decisions against the money that it lobbied for in Washington.
I want to pop back to Merck earnings if we can. We're kind of jumping timelines here, but really what this is, I want to keep viewers on their toes. I don't want people just to say, okay, this is a predictable broadcast. You never know where we're going to go. Martin and I are getting wild on it Thursday. We're going back to the open for Merck. That company reporting better than expected earnings, Martin, as the drug maker beat on both the top and the bottom lines here for Q3. I wonder from your perspective what some of the biggest contributors were to the company's successful quarter.
For the most part, it's a single name story for Merck, and that's Keytruda, the blockbuster cancer drug. It's used in treatments with other therapies as well, so it has great utility, and its sales have been growing pretty much on a quarterly basis since its FDA approval. It was up 20% in point of fact compared to the same 3-month period last year, and it really is the principal driver of their earnings growth. Now, they're seeing the potential for deeper sales from its COVID pill, whose name I simply cannot pronounce at this point. But nonetheless, for the sake of Merck, it's more about Keytruda than anything else. And they've been able to consistently just nudge up their full year sales and profit forecasts as a result. It's been an excellent defensive stock in this market. I think it's only down about 2 or 3% so far this year. It's very difficult to find a company in the Dow that's been able to hold on to at least some semblance of a gain against the broader market decline. But Merck is just, again, another example of these old school stocks that is using, of course, very sophisticated innovation to drive sales and earnings, and therefore presenting investors with a defensive aspect to the portfolio that simply isn't being found in a lot of other stocks this year.
We're going to move on to Elon Musk here, and what's amazing, Martin, is that I was writing the show last night into early this morning. I said, okay, we're going to have a little bit of fun. We're going to show the, let it sink in tweet. That goofy video indeed. Of Elon Musk walking into headquarters, but then suddenly we actually do have a pretty substantive comment, dare I say. The man takes to Twitter, appropriately so, and you and I had a quick debrief about it before the broadcast to say a bit more conservative, right? He's trying to do something here. He's trying to assuage some concerns. If we could pull up part of the statement here, I'm just going to read a very brief part of it. Elon Musk saying on this Thursday morning, the reason I acquired Twitter is because it's important to the future of civilization to have a common digital town square. I didn't do it because it would be easy. I didn't do it to make money. Twitter obviously cannot become a free-for-all hellscape, he goes on to say. The platform must be warm and welcoming for all. Martin, what are we to make of this very specifically worded statement that was just released?
I'm reminded of the old adage in politics, JD, which I'm sure you're familiar with, and that is a conservative is a liberal who has been mugged by reality. It's interesting to me that Elon Musk is reaching out to advertisers whilst at the same time saying that he's not doing this to make money. Obviously he is, because he would make that statement to Twitter users rather than to people who are ultimately going to pay the bills. So he does care about this. He does care about the economics. And what he is being mugged by is the reality that his vision of a free speech absolutist platform is simply not feasible in this kind of the political dynamic. It's simply not workable. And he understands that now. He understands it even more so given the fact that he's having to pay a significantly higher premium for the stock given its position in social media today and the broader marketplace today than he contemplated back in April. He said as much to Tesla investors on the earnings conference call last week. He said he's obviously overpaying for it. He's going to have to sell Tesla shares in order to do so, and he's going to have to borrow at least $13 billion, if not more, at reasonably high costs, and he has to pay that back. Suddenly, the economics of his Twitter purchase become far more important than the free speech aspects, and that, to me, seems to be why he's changing his tone this morning.
Absolutely. Okay, we got a few minutes left here in the broadcast. It's time now for rapid fire. By the way, that last topic, I could also do an hour-long show with you. Maybe we will next month. Time now for rapid fire. We'll try and get through these quickly. First up, Amazon earnings. Will web services hold the line? Big one here today.
That's going to have to be how it plays out, JD, because what we are seeing in web services more broadly is not good. We had, of course, those weakening growth rates for Azure earlier in the week. Google's web services was okay, but not great. Amazon web services is really the underappreciated aspect from a common point of view for Amazon stock. analysts and, of course, and professional investors understand how important it is. So I'm going to be focusing on that, maybe even more so than what the company has to say about consumer and retail demand heading into the final months of the year.
And believe it or not, because we hit most of our other rapid fire topics in our, I'm biased when I say it was an outstanding conversation, but it was an outstanding conversation. So that's going to bring us right to Pigskin. Thursday night football, Tampa versus Baltimore. Who do you like tonight, Mario? At least we got football back.
No, this is not a bad Thursday night matchup, is it? It has to be said. I think you've got some quarterback star power with Brady and Jackson going up against one another. Neither really, though, are playing at the levels that we saw last year for a host of different reasons. But oddly enough, as badly as Tampa Bay is playing, if they get a win tonight, they can probably see their way towards winning the division and working their way into the playoffs. But Brady hasn't looked particularly good in these past few weeks, and he's on short rest. So I'm not sure that I like him, even though there's some points involved in taking the Bucks. So I think I'm going to have to go with Baltimore.
I mean, at some point, he's got to turn it around here this season, right? If the Bucks are going to compete. Same for the Packers. I mean, you've got these legacy teams, and at some point, we're going to sit there into November, and they're going to look around and say, oh, shoot, we didn't win those early season games that we kind of needed if we're going to make the playoffs. Makes me all the happier to be a Giants fan when suddenly we're sitting there with 6 wins saying, hey, we can go 500 the rest of the way, and we still have a pretty decent shot at the playoffs, if not making it outright. Real quick, you hyped for your Dolphins this weekend?
What I was going to say, Jesus, no one is an island in football. I mean, Belichick without Brady is a different story. Brady without Gronkowski is a different story. Aaron Rodgers without Devontae Adams, a different story. So I think we're understanding now that the pairings of the top players in the league are incredibly important to what these teams can do. And as much as we like to sort of lay the benefits of success at an individual player, in a game with 22 men on the field, you simply can't do it alone.
Of course. Is Peyton Manning without Marvin Harrison? I don't know.
There you go.
Historians will debate questions like that for many years to come. For now, that's going to be the conclusion of our debate and conversation this morning. The great Martin Baccardax. What a show. What a series of topics. Thanks for being a true professional as always, Martin.
Thanks, JD.
You got it, man. All right, that's going to do it for the Market Open here from the floor of the NYSE. Stick with TheStreet.com for more on these and all of the major market stories that matter to you. We'll see you later.